Hello everyone, welcome to Tesla Daily News. Today is June 22nd, Monday, and the following is the latest Tesla news. According to market data, Tesla stock closed at about $405, up slightly from the previous close near $400, after trading between roughly $394 and $415 on strong volume. Technically speaking, bulls defended support and challenged recent resistance levels. The intraday low held just above the open, suggesting dip buying interest, while the high around 415 is now the key level for any further breakout attempts. With shares still pricing in huge expectations for autonomy, AI, and robotics, investors should remain aware that traditional valuation metrics, like price-to-earnings ratios, continue to look extremely stretched. According to the Motley Fool, Elon Musk just exercised his entire massive 2018 Tesla stock option package, instantly boosting his voting power in the company to nearly 20%. The options, more than 300 million shares on a split-adjusted basis, carried a strike price in the low 20s versus a stock price above $400 at the time of exercise. Musk could have waited until August to exercise, but chose to lock in the voting rights immediately. The key detail here is that, under Tesla's agreement, the economic value of these shares does not vest until 2028, yet the voting rights are effective right now. The Motley Fool mentions that this move fits Musk's long-stated desire for stronger control over Tesla as it transitions from an electric vehicle company into an artificial intelligence and robotics powerhouse. In early 2024, when his stake was closer to 13%, Musk said publicly that he was uncomfortable pushing Tesla toward a leading role in AI and robotics unless he could secure around 25% of the voting power. He described that level as enough to be influential but not so high that other shareholders could never override him. According to the report, this increase in voting power comes just days after SpaceX, Musk's private space and AI company, began trading publicly following an enormous initial public offering that valued the business around the upper trillion-dollar range. Now that SpaceX has a liquid market valuation and publicly traded shares, speculation about a potential Tesla-SpaceX merger has intensified. Wedbush analyst Dan Ives has even suggested the odds of some form of merger within roughly a year are quite high, while prediction markets put the probability of a deal over the next several years closer to even. The article explains why a merger is at least conceptually appealing. Tesla's future strategy emphasizes self-driving software, the Optimus humanoid robot, and large-scale AI training, while SpaceX controls the Starlink satellite network, its own AI research through xAI, and is reportedly building a chip plant alongside Tesla in Austin. A combined company could more tightly integrate AI compute, robotics, satellite connectivity, and autonomous vehicles into a single vertically integrated ecosystem. For long-term Tesla shareholders, such a combination could, in theory, spread development costs and accelerate commercialization of advanced AI and robotics. On the other hand, the report cautions that many uncertainties remain. SpaceX now carries a higher market capitalization than Tesla, and Musk controls a super voting share structure at SpaceX that gives him far more than simple majority control there, compared with his stake at Tesla. Any merger terms would heavily influence which group of shareholders ends up owning what portion of the combined entity. Moreover, Tesla's core auto business is facing margin pressure and more modest growth, with vehicle production running ahead of deliveries and profitability still thin compared with its enormous market cap. That means the current Tesla share price already assumes highly successful execution in autonomy, AI, and robots. For stock investors, the message is that a merger could unlock synergies, but it is not a guarantee of better returns, especially if the deal terms or execution disappoint. According to the Australian Financial Review, Tesla's longtime institutional backer Hyperion Asset Management has doubled down on Elon Musk by adding a significant stake in SpaceX alongside its already large Tesla position. Hyperion, a Brisbane-based fund manager overseeing about $12.5 billion, has been one of the strongest Tesla bulls in the Australian market for years. Tesla accounts for more than 12% of Hyperion's flagship global growth portfolio, making it one of the fund's largest single holdings. The Australian Financial Review notes that Hyperion informed its clients it recently purchased SpaceX shares for its $3.8 billion global growth fund, assigning the position a mid-range weighting compared with its other holdings. For Tesla and Musk followers, this development is notable because professional money managers are increasingly treating Musk's ecosystem Tesla, SpaceX, and related AI ventures as an integrated long-term growth story rather than a collection of separate, unrelated bets. From an investor's perspective, this reflects a thesis that Musk's companies may benefit from shared technology, talent, and infrastructure across EVs, space, satellites, and AI. Jefferies, as reported by DPA-AFX, has raised its price target for Tesla shares from $350 to $375, while maintaining a hold rating. According to this research note, the analyst argues that traditional valuation measures have become almost irrelevant for Tesla at this stage, given the market's focus on the company's long-term disruption potential in energy, autonomy, and AI rather than on near-term automotive margins. According to Jefferies, a merger between Tesla and the newly public SpaceX could be strategically attractive. The analyst highlights that the two companies' business ambitions are increasingly intertwined. Tesla is pushing deeper into AI, robotics, and energy storage, while SpaceX is scaling its satellite communications network, launch operations, and AI-related activities. A combined entity might have more robust cash flow, better access to capital, and greater leverage over suppliers, especially in semiconductors and high-performance computing infrastructure. For current shareholders, Jefferies' stance underscores how seriously the investment community is taking the possibility of a large-scale Musk corporate consolidation, even while the firm's rating implies neutral near-term risk-reward at current prices. According to Comanda, Tesla faces a serious regulatory challenge in Europe that could threaten the rollout of its full self-driving system across the European Union. The article reports that Sweden's transport authorities, Trafikverket and the Swedish Transport Agency, have informed the EU's Technical Committee for Motor Vehicles that they intend to vote against EU-wide approval of Tesla's FSD unless a particular speed-related feature is removed. The controversy centers on FSD's European modes. One mode, called contextual max speed, is designed to respect local speed limits. The other, called speed offset, allows drivers to set a specific margin above the legal limit, effectively enabling the system to deliberately drive faster than posted speeds according to user preference. Swedish regulators argue that this design conflicts directly with the EU's intelligent speed assistance rules, which since 2022 require systems that warn or discourage speeding, not ones that facilitate it. According to this report, Sweden's position is not isolated. Regulators in Finland and Norway have also raised concerns, and even Estonia and Denmark, which have allowed FSD in some form, expressed discomfort before granting approval on the rationale that drivers ultimately remain responsible. Under EU approval rules, a Europe-wide green light for Tesla's FSD requires support from at least 15 of the 27 member states representing at least 65% of the EU population. If the committee vote at the end of June fails, the Dutch type approval that currently underpins FSD deployment in several countries would automatically expire after 6 months, which would in turn invalidate other national approvals. For investors, this is a meaningful risk. According to the article, Tesla could theoretically resolve the issue with a simple software update removing or heavily modifying the speed offset function in Europe. However, the company has not yet fully conceded. The piece frames this as a broader cultural clash between Silicon Valley's flexible approach to user choice and Europe's rules-driven traffic safety regime. If Tesla misjudges the regulatory mood, it could lose not only months of approval work but also strategic momentum in a region where lawmakers are drawing firm red lines around how driver assistance systems are allowed to behave. Car Expert in Australia reports that Tesla has started rolling out its latest full self-driving supervised software, version 14.3.3, to customers in Australia. This update is targeted at vehicles equipped with the newer hardware 4-camera and computing suite, currently found in the latest Model Y and Model 3 sold in the country. Notably, the Model Y recently became the top-selling new vehicle in Australia across all fuel types, beating out long-time leaders such as the Ford Ranger and Toyota Hilux, underscoring how central this model is to Tesla's global growth story. According to Tesla Australia's description cited by Car Expert, the software uses an upgraded reinforcement learning training stage for its neural networks, which should reduce the number of times drivers must intervene while using FSD. The update also includes a more advanced neural network encoder for interpreting the driving scene, improving understanding of traffic signs and delivering an estimated 20% faster reaction time. Tesla claims better behavior around emergency vehicles, fewer unnecessary lane changes, improved handling of complex intersections and roadworks, and even more accurate interpretation of small animals on or near the road. Car Expert notes that the update introduces a new sloth speed profile in addition to existing chill, standard, and hurry modes. Sloth is designed to drive more conservatively, with lower speeds and more cautious lane selection. Tesla says the differences between the various speed profiles are now more pronounced, giving drivers clearer choices about how conservative or assertive the system should be. The user interface has also been refreshed, with the FSD computer now labeled the AI computer and new on-screen options for what the vehicle should do upon arrival, such as selecting different parking or drop-off behaviors. For Tesla watchers, This rollout is important because it shows steady progress in deploying advanced driver assistance beyond North America, even as European regulators raise objections. Australia is becoming a meaningful test market for FSD features, and the wide usage of the Model Y there offers Tesla valuable real-world data that could feed future improvements. This supports the long-term thesis of Tesla as an AI-heavy mobility platform, though the system remains supervised and drivers are still required to pay close attention. According to several U.S. media outlets, including the Star Advertiser via the New York Times, ABC 13 Houston, and Business Insider, a tragic Tesla crash in Texas has once again put the company's driver assistance technology under intense scrutiny. The incident occurred in Katy, a community west of Houston, when a Tesla Model 3 driven by Michael Butler left the roadway at high speed and crashed through the brick wall of a home, fatally injuring a 76-year-old woman inside. Authorities in Harris County stated that the driver reported the car was operating with an automated driving assistance system engaged at the time of the crash. According to ABC 13, home security footage and doorbell video captured the vehicle traveling down a residential street at what neighbors described as extremely high speed. Some witnesses estimated around 60 to 80 miles per hour before it jumped a curb and slammed into the house. The impact was so severe that the car entered deep into the structure, striking the victim, who was later airlifted to a hospital and pronounced dead. The sheriff's office indicated that the driver did not show signs of intoxication and has been cooperative. However, investigators have not yet confirmed which specific Tesla feature was in use, whether standard autopilot or the more advanced FSD Supervised, and they are still examining why the car failed to stay within its lane and why its speed was not controlled before impact. Visible flashing lights on the vehicle before and after the crash raise questions about whether any warnings or system transitions were occurring. From an investor and regulatory standpoint, this crash matters because Tesla's driver assistance systems already face ongoing investigations and legal challenges. Recent court cases in Florida and California have debated both Tesla's technical safety and its marketing language, including whether calling the system autopilot is misleading. High-profile tragedies like the Katy crash can influence regulators, juries, and public perception, potentially leading to stricter rules, forced software changes, or even limitations on future automated features. For Tesla's long-term AI and autonomy narrative, maintaining or rebuilding trust with regulators and the public is crucial. According to Nezavis, citing reports from China, some Tesla drivers in that market have begun using small plastic heads and other decoys to trick the company's driver monitoring system when using full self-driving. Tesla's in-cabin camera is designed to ensure the driver is paying attention to the road. If the system detects that the driver is looking away for too long, it issues alerts and can limit functionality. However, Chinese media report that some owners are placing miniature busts of celebrities or other figurines directly in front of the camera to simulate a human face looking forward, thereby preventing warnings from triggering. Other tricks reportedly include printed facial photos, animated eye-blinking images, or small screens playing videos of a face. These methods aim to fool the algorithm into thinking the driver is watching the road while the actual person may be distracted, for example by a smartphone. For Tesla investors and enthusiasts, this trend highlights an important point. Even the best driver monitoring systems rely on some level of user cooperation. If enough drivers attempt to circumvent safety features, regulators may demand more robust, possibly hardware-based safeguards and harsher penalties for misuse. This could increase Tesla's costs and delay the approval of more advanced autonomous functions. It also reinforces why Tesla continues to emphasize that FSD is supervised and that drivers must keep their hands and eyes engaged, no matter how capable the software becomes. According to HEG in Hungary, Tesla is preparing a new push into the AI hardware and data center market with a product concept it calls Megapod. The company has filed to trademark the Megapod name with the U.S. Patent and Trademark Office, describing it as modular hardware designed for running AI workloads in data centers. In simple terms, Megapod would be a building block unit that can be deployed inside existing AI data centers to expand capacity quickly or combined with other units to form an entire modular facility. HEG explains that Tesla is entering a space already dominated by established players. NVIDIA, for example, offers the GB200 NVL72 system, a rack-mounted, liquid-cooled platform containing dozens of Blackwell GPUs and Grace CPUs, functioning as a massive single AI accelerator. These can be scaled up in clusters like the NVIDIA DGX SuperPod, which can aggregate thousands of GPUs. Companies such as Dell and Supermicro already build and sell their own systems using this architecture. The report also notes a potential naming issue. Another company, Sumair, already markets a product called Megapod, a prefabricated 12-meter modular data center. However, Tesla may still secure the Megapod trademark because it has applied within a different product category focused on computer hardware rather than turnkey data center structures. HVG points out several challenges Tesla faces in this arena. Tesla is not currently a traditional data center hardware vendor and is itself a major NVIDIA customer rather than a direct rival. Moreover, Tesla's earlier attempt to build its own AI training supercomputer, Dojo, was paused in August 2025, with Musk later calling the Dojo 2 concept an evolutionary dead end. This track record may make hyperscale customers cautious about betting on Tesla for mission-critical AI infrastructure. For stock investors, the Megapod idea is another sign that Tesla wants a larger slice of the fast-growing AI compute and data center market, beyond just using AI internally for cars and robots. If Tesla can successfully design, manufacture, and sell modular AI hardware, it could create a new revenue stream and strengthen synergies with its own AI ambitions. But the competition is intense, from NVIDIA to traditional server manufacturers, and execution risk is high. According to 7 News and Car Expert, Tesla's broader autonomy roadmap also features the dedicated robotaxi Cybercab, with 2 examples recently spotted in New Zealand for cold weather testing. While these sightings are not an independent news item with extensive detail, they serve as a reminder that Tesla is already operating driverless robotaxi services in some U.S. markets as of 2025 and is gradually adapting its vehicles and software for varied climates and geographies. For enthusiasts, this suggests that even as regulatory and safety challenges arise, Tesla continues to iterate toward a global autonomous mobility network. Thank you for listening to Tesla Daily News. If you enjoyed this episode, please subscribe and stay tuned for more updates.